All right, let's just jump right in. Look, when a guy like Ray Dalio, the billionaire who literally called the 2008 financial crisis, since we're in a massive bubble, you kind of have to listen, right? But what if that same guy then says he's not selling? Now that's a head scratcher. That's the Dalio paradox, and that's the puzzle we're going to unpack today.
So this is the quote that really gets to the heart of it. Dalio's out there saying there's definitely a bubble in markets. But then he follows it up with, but we don't have the pricking of the bubble yet. See what I mean? He's sounding this huge alarm with one hand, but with the other, he's basically saying the pin that's going to pop it isn't even in the room yet. It's a total contradiction, and it's got a lot of smart people wondering what's going on.
So, that's the big question, isn't it? What is really going on here? What does a guy like Ray Dalio see that maybe the rest of us are missing? We're going to break down his thinking, piece by piece, to figure out why he sees this huge risk on the horizon, but also maybe one last explosive party before the lights go out. Okay, first things first. Let's get inside Dalio's head a little bit. What does this bubble actually look like to him? What are the signals that are just screaming danger? And you gotta understand, this is not just some gut feeling for Dalio. He's seeing these really specific, almost spooky echoes from history. You look at this. On one side, you've got the 1929 crash, the 2000 dot-com bust. And on the other side? Well, that's today. We're seeing things like equity wealth compared to the money supply hitting those same 1929 peaks. And all this intense focus on just a handful of stocks, he calls it the AI beta chase. Man, that feels exactly like the dot-com bubble all over again. For Dalio, this isn't just history rhyming, it's practically shouting at us.
Yeah, and that's the crucial thing to get here. This is not guesswork. Dalio has his whole proprietary system, his bubble indicator, that tracks all these different metrics, pricing, new buyers, that euphoric feeling in the air, and he's saying that right now that indicator is relatively high. It's not redlining at its absolute peak just yet, but believe me, it is flashing some very, very serious warning signs that things are getting way too hot. All right, so if the market is this big, growing bubble, you have to ask, what's stopping it from popping? I mean, what's the fuel that's keeping this fire burning? And maybe, just maybe, making it burn even hotter before it goes out. $37 trillion. That's a number that's hard to even wrap your head around, right? That's the U.S. national debt. Dalio calls this stuff the plaque in the arteries of the economy, a massive, long-term problem that could absolutely lead to an economic heart attack. But here's the wild paradox. In the short term, this exact same debt is part of the fuel that's inflating the bubble. How on earth does that work? Well, let's break it down. And this right here, this is the core of his whole argument. Think about it. Back in 2008, central banks pumped stimulus into a depression to try and revive a dying economy. That makes sense. But today, Dalio's warning that they're about to pump stimulus, like cutting interest rates, into an already inflated bubble. This is a totally different ballgame, and it is way, way more dangerous. And this is the cycle he sees playing out, this kind of self-fulfilling prophecy. Step 1, the government has these massive deficits it has to pay for. So, step 2, to keep the whole system from breaking and to keep interest payments from going through the roof, the central bank is pressured to cut rates to make money easy. Then, step 3, all that easy money has to go somewhere, right? It floods into the financial markets. And what happens next? Step 4, the bubble just keeps inflating. It becomes this loop that just feeds on itself. Okay, now we need to zoom way out, because for Dalio, this market bubble isn't just happening in some kind of vacuum. No, he sees it as just one symptom of a much bigger, much more profound global shift, the kind of thing that really only happens once in a generation, or maybe even once in a lifetime. He places the U.S. squarely in the late stage of what he calls the big debt cycle. This is a historical pattern he's traced back for centuries, where great powers rise and then eventually decline. And if you look at this checklist of symptoms for that final stage, man, it is uncomfortably familiar, isn't it? High debt loads? Check. Printing money? You bet. Rising conflict both at home with wealth gaps and abroad with trade wars? Check and check. It's a pretty sobering picture when you lay it all out like that. So what's the real-world consequence of all this debt? Well, this is huge. Dalio is warning that the U.S. dollar's traditional role as a safe place to park your money is eroding, and it's eroding fast. With so much debt that has to be paid for by printing more and more money, he basically says it's naive, that's his word, for any other country to lend the U.S. money and actually expect to get paid back in dollars that have the same value.
And he sees stuff in the news every day, like tariffs and trade wars, not as these isolated little spats, but as things that are actually accelerating this whole breakdown. Think about it. Every new tariff forces other countries to rethink how much they rely on the U.S. It pushes them to plan for a future where they're less tied to us, to create these new economic alliances that just bypass America completely.
Okay, so let's recap. We've seen the bubble, we've seen the fuel that's keeping it pumped up, so that brings us right back to the central paradox, the big question. If all this is true, why on earth wouldn't you sell everything right now? What is Ray Dalio waiting for?
The answer is he's not just waiting for a gut feeling. He is watching for very specific triggers. Number one, a big reversal in monetary policy. We're talking about things getting significantly tighter, not easier. Number two, major fiscal policy shifts, like huge new taxes or tariffs that really shock the system. And number three, this is the big one, an acute liquidity crisis. That's the moment where everybody suddenly needs cold, hard cash at the exact same time, and there just isn't enough to go around. Until one of those three things happens, he thinks this bubble still has room to run. And that's why his advice isn't get out of the market. It's much more nuanced. He's saying you need to restructure your portfolio for safety. He suggests being protected, owning assets that actually do well when currencies are getting weaker, think gold, and at the same time, getting rid of any major credit risks that could just completely blow up on you in a liquidity crunch.
And this bar chart, wow, this just perfectly illustrates the long-term danger, even if there's one last party in the short term. Just look at the difference here. The last decade, we got these incredible 9 to 11% average annual real returns. It was amazing. But what are Dalio's models forecasting for the next decade? Look at it. It's a flat line. Basically, zero. That's a huge warning that any final surge we see in this bubble isn't actually creating new wealth. It's just stealing returns from a pretty barren-looking future.
So that's really the final takeaway here. The party might have one last great song to play, but Dalio is convinced it's going to be followed by a very, very long and quiet morning after. So the real question isn't whether you can time the absolute top of the market. The real question is this: is your financial strategy prepared for the reality of a lost decade of returns?